Greetings, it's time for another CrashWatch video in our CrashWatch series of videos. And I hope you enjoyed the prior several videos in the CrashWatch series because, as you will note, I predicted this head and shoulder pattern formation as well as the subsequent market decline and explained in detail what the various reasons were and what the factors were. And remember, these videos are for educational purposes, so they're not just relevant just a couple of days after each individual video. They are helping you learn about technical patterns in the market, various macroeconomic forces, and the effects on market pricing and multiples and dynamics based on things like earnings, Federal Reserve action, oil prices, and so forth. And these are meant for educational purposes. Don't do any trade or not do any trade just based on any of my videos. They're meant for educational purposes so you can learn about how to analyze your own charts and come to your own conclusions. So here we are with the S&P 500 and its dynamic after the head and shoulders pattern that I have described in detail. So let me hide my face. You can see here with the cursor the head and shoulders pattern, and I started making these CrashWatch videos around here, and sure enough this right shoulder formed and this neckline was breached, and the market has fallen much more rapidly since. The rate of fall is increasing. That is good because that leads to a certain capitulation type of dynamic, which is ultimately what needs to happen before a bottom is formed. But since the Federal Reserve has begun tightening, and they still haven't begun to unwind the quantitative easing they have done in the past, they've only stopped new printing and have announced an unwinding schedule. But June is to be the first month of unwinding, and they're still only unwinding a puny 45 billion. Now, of course, they should not be unwinding at all. They should be doing permanent QE, but that's for other reasons that I describe in other videos on this channel. Once the reversal of QE, the quantitative tightening, starts, we will get to a much more rapid correction. Now, I have said the ultimate bottom is in the low 3,000s, at least, possibly lower. And so far, the momentum of this is not leaving any reason to think otherwise. So the S&P 500 is undoing the big rise it had because of COVID. And ultimately, you have to see the trend line is closer to what you see here in these 2017, 18, and 19 peaks and troughs. And so ultimately over here is where you have a pretty good entry point. It could go lower than that, but I would consider an entry point in the low 3,000s to be relatively good if you want to just put your money in an index like the S&P 500 and not look at it for many, many years. Because remember, the gradient itself is rising as we get closer and closer to a technological singularity in 40 years' time, or just further along in the accelerating rate of change if you don't want to think that far. Then this is how things could manifest pretty favorably if you enter over here. Recall that I said over here that the bottom in the low 2000s was one of the best entry points any of us would ever see in our lifetimes, and that was in fact true. And I have that in my Twitter stamped at the time that it was there, and that became a pretty well-known call of the bottom at the time. But again, these are just my opinions, and no one should trade or not trade based on what I say. So this is the head and shoulder pattern manifesting. Now, what is interesting here is, to the extent that the Federal Reserve is manipulating or managing the market, they've actually done a decent job. This is an orderly correction. It's not a huge plunge that scares everyone. It is somewhat more gradual. Now, it's getting faster and faster, kind of a sawtooth motion. That's not good, but that means that we could have a bottom before there's that much Federal Reserve tightening and a certain amount of tightening priced in. I don't think it's that soon. I think the ultimate bottom in the low 3,000s could be more in the October timeframe. It's still June right now, but this is where we are with the S&P 500. Now, another thing pressuring the market is oil prices, so let's go over there. This is USO, United States Oil Futures, which is the West Texas Intermediate Oil Futures rolling ETF. And unfortunately, because the US government has decided to obstruct domestic oil and natural gas production, oil prices rose. They were at about $50 a barrel from 2015 through 2021, and the stoppage of U.S. domestic oil production in all the sites that were contributing to the oil supply through hydraulic fracking has in fact been executed, and therefore that pushed oil to $80 a barrel, which in turn then emboldened Russia, which is an oil exporter, to engage in warlike activities, an invasion of Ukraine to be exact, which they haven't done since oil was previously very high in 2014, which pushed the price of oil higher still to about $120 a barrel. Now, under atom principles, this is causing a tremendous demand destruction of oil very quickly and or adaptations around oil. Electric vehicle sales would be much higher than they are now if there was just enough supply. There is also much less driving than before. So we are seeing a tremendous adaptation around higher oil prices that could not have occurred in 2014, let alone in 2007, which was the beginning of the previous oil spike that kept oil prices high from 2007 to 14. Now the technomic medium of the world is much more advanced than it was in those days, so the speed up of disruption is much faster. Now the candle is being burned on both ends. The demand destruction and the atom consumption that triggered all these innovations from the high oil prices of 2007 to 2014, now it would just take half that amount of time. So oil might stay high for only a year or 2 years or 3 years, or much less if the stock market corrects sooner. And then we will have more permanent demand destruction of oil. But at the moment, high oil prices are affecting everything from US trade balance to the earnings of companies, to consumer confidence and consumer spending, because as we know, the average consumer judges inflation based pretty much on just a couple of things, gasoline being the most prominent one of them. Even if other things are not rising in price, if gasoline prices are high, the effect on the psyche of the average American is extremely pernicious, even if that same inflation caused their home price to rise so much that they have a lot of home equity, and we talked about that in other videos on this channel. So this is oil prices as a pressure effect on the S&P 500. So now we go to the next chart. This is the 30-year mortgage rate from the Federal Reserve. And as you can see over here, the mortgage rate recently went to an all-time low, and so everyone's home price went to all-time highs. People were surprised at how high the price of their homes became and how much equity they had. However, this is the steepest rise in mortgage rate pretty much ever, but certainly within this window of time, which goes all the way back the last 20 years. The previous housing crisis did not have a rate rise anywhere near as drastic. Mortgage rates were somewhat low in 2004, 2005, which fueled that bubble. Then it rose somewhat, not a lot, which caused a housing bust, and rates had to be this low for this long just to recover from that housing bust. Now, unfortunately, since the Federal Reserve does have to print money just to offset technological deflation, the way they do it is wrong in that they buy only two things, treasuries and mortgage-backed securities, which I speak about very extensively on this channel, how that is too narrow of a type of monetary creation, and it distorts those markets, while a lot of cash does not reach people who do not own stocks or do not own their own home. It's really, really quite pernicious how money is not reaching the people who need it the most if the Federal Reserve is going to print anyway. And the cynics say this is actually a plan to try and kill off the lower classes. Now, I don't think that's true. I just think that PhD economists are so theoretical that they still think they can unwind the Federal Reserve balance sheet. Therefore, they buy things that have a deep market, so to speak, when unfortunately they are pushing on a string, and that's been true for some time. So this low interest rate in response to COVID-19 and the structural decline in interest rates is certainly happening for sure. However, the stoppage of purchases of mortgage-backed securities, which has not even been reversed, they haven't even started to unwind the balance sheet yet. Just the stoppage of purchasing of mortgage-backed securities has shot up the interest rate on 30-year mortgages all the way up to 5.78%. That is not just a 12-year high, but that is a dramatic rise from just a few months ago. And so a lot of homes are going to go back in price to what they were in 2019 or earlier. Now, the problem is a lot of people bought homes at the high price because a lot of people don't understand that when interest rates are low is when you don't want to buy a home. You want to buy when rates are high, then wait for interest rates to be low, and that's how you make home equity. If you buy when interest rates are low, you're buying at a higher price, and since there's two variables in that equation, a lot of people don't understand that. 3% loan on $1 million mortgage is not as good as a 5% loan on a $600,000 mortgage. A lot of people think the payments are the same, therefore it's the same, but no, your potential for equity gain upside in each case is very, very different. And these are major, major life-changing decisions about when to buy a home and when not to. And this type of rise in a mortgage rate will have catastrophic effects on the mortgage market and on housing prices in just a few months' time, causing a deep recession, and the Federal Reserve will have to resume money printing again. They should never have stopped in the first place. This, of course, will cause the S&P 500 to fall further and be another dampening effect on the stock market. That is another thing to think about, because that feeds on the inability of people to service their mortgages. It becomes a debt spiral, and the Federal Reserve can always cure that by printing more money, but they shouldn't stop in the first place and cause all these extreme swerves from one extreme to another. They use very blunt instruments when they should use a more sophisticated, more granular, laminar flow of money printing, which I've advocated for many, many, many years, as longtime viewers and readers know about. So this is another dampening negative force on the stock market and the economy as a whole. So there you have it. This is the CrashWatch video for June 20th, 2022. The S&P 500 has already corrected substantially from its high, but there's a fair bit lower to go in my opinion, because the Federal Reserve will not simply resume printing again until unemployment rates are high and home prices have crashed quite a bit. And that's why I say low 3,000s, possibly lower, but low 3,000s is a respectable entry point for those with cash on the sidelines who just want to be in the market long term. I hope you found this to be informative, and I urge everyone to watch other CrashWatch videos in the description box below to receive a holistic education of all of these factors. Thank you very much for watching.